morning, Insignio. Today's April 29th. We've got a very special guest with us today from Lord Abbett. We've got Michael Cibelli. Michael, welcome to the show.
Thanks for having me.
Absolutely welcome. So Lord Abbett is one of our key partners here at Insignio. And without any further ado, let's get right into capabilities of the firm. You guys have 222 billion in assets, the majority in fixed income. Take us away.
Yeah, thanks, Alejandro. Yeah, the quick background to 220, as you said, 30 billion in equity, 100, about 190 in fixed income, over 5 billion in alternatives, which what we're here to talk about today, the credit opportunities portfolio is certainly falling under that umbrella. And one other thing I'll mention in terms of a commercial for Lord Abbett is, Barron's ranked us the #1 fund family in 2024. So over the course of the 5-year period, we're number 6, and in 2024 we ranked the #1 fund family in Barron's.
That's incredible. So, in that there's a 5 billion sleeve that's alternatives, and as we think about credit ops, there's sort of in my mind like a hybrid feeling of like fixed income, but there's some alternative nature to it.
That's right.
Let's unpack that.
Yeah, for sure. So the way we would think about, I'll back up to the genesis of the strategy a bit and give a kind of a quick history lesson here. When we 6+ years ago launched the strategy, the problem we were trying to solve for was that our fixed income platform was passing on a lot of really interesting investment ideas, really high return potential, very attractive risk-adjusted returns. The reason they were passing deliberately is because many of them weren't appropriate for a mutual fund that offered daily liquidity. And they weren't appropriate potentially because of the complexity there. Maybe they didn't represent benchmark-like risk. Maybe the liquidity was lower. They were tradable, they were marketable, but they had lower trading volume. Think about ABS tranches or CLO tranches that just have lower trading volume than your typical corporate bond. And so they just weren't appropriate to either own at all in a traditional fixed income mutual fund, or to size meaningfully. In other words, we might actually own things in credit opportunities that we own in a traditional high yield or multi-sector fund here at Lord Abbett, but the weighting would be significantly different. So maybe it's 10 basis points in the Lord Abbett high yield fund, maybe it's a 1.5% in the credit opportunities fund. But because we have the quarterly redemption structure, the interval fund wrapper, we now can take advantage of some of these ideas that we had historically passed on. So that's sort of the genesis of the strategy, is not let's launch an interval fund because interval funds are growing, but let's find the solution for us to start taking advantage of these really attractive ideas. And the interval fund format was that solution for us 6+ years ago. I'll just mention one other thing, in terms of the hybrid, alts tradable, we do invest in tradable credit in this portfolio. We do have some exposure to private credit. It's about 3.84% of the portfolio, but this is largely tradable credit. And that's where you kind of come up against the hybrid between, traditional and alternative. It's traditional in the sense that we're investing in tradable. It's alternative in the sense that, as I mentioned, a lot of this comes with complexity or liquidity factors that wouldn't be appropriate in that traditional fund, and therefore we're in an interval fund structure. So we do consider this an alternative, and we do consider this a complement to more traditional credit portfolios. It can coexist with a traditional high yield fund. It can coexist with a traditional multi-sector fund. And of course, it is a great complement to private credit.
Interesting. So 5 decades of history investing in multi-sector credit. And when did this fund start? And walk us through some of the early days, and has much changed since when the fund started?
Yeah, for sure. So, 50+ years in leverage credit, multi-sector credit. So just backing up there. So in 1971, we launched our bond debenture fund. That was a multi-sector credit portfolio. Just back up, we opened the doors of the organization in 1929, so much further back in time, one of the older money managers in the industry. But we think about credit, leverage credit particularly, 1971 is really where we made our mark as a pioneer, or it's a a leader in leverage credit. If you think about when the high yield bond market was incepted, it really was in that 70s period. So, that is pretty much as far back as you can go to have a track record in leverage credit. So that being said, we've broadened out our credit platform since then, and now we're looking at over 100 billion in corporate credit, over 40 billion in securitized credit, and as we said, we launched the Credit Opportunities Fund about 6+ years ago, February of 2019 to be exact. And the portfolio has changed in terms of its allocation. It is multi-sector, and you would expect it to be tactical from the standpoint of sector allocation. I will point out that when we think about sector allocation, it's not a traditional multi-sector fund from the standpoint of top-down views on sectors. So when I say the sector allocation has changed, that's a byproduct of the idiosyncratic ideas that we have found over time. And so we're not thinking about it as, hey, we like XYZ sector, let's rotate there. We're more thinking about it, have we found a number of idiosyncratic ideas with really attractive risk-adjusted return profiles that we feel are misrated or misvalued or dislocated in some way. And when we invest in those, whatever the byproduct, whatever the sector allocation winds up being, that's where it lands.
So a very interesting and dynamic soil chart as we see where you've been, where it might head based on bottoms up. Where are you finding the most interesting or exciting opportunities currently?
Yeah, and for that, maybe I'll just for a visual, see if I can share my screen. Can you see my screen?
I can.
Okay, fantastic. I'll make it a little bigger because big enough here. So what you see here in blue, the blue bars, that represents sort of an expected range in terms of sector allocation. And then the diamond represents where we are as of the end of the first quarter, right? It hasn't changed dramatically today, and so I'll talk through it. To answer your question, the 4 primary asset classes we're currently allocated to are high yield bonds, which is the largest. Now, again, these are, tradable high yield bonds. However, they may be opportunities that we don't own in a traditional high yield fund, or we size differently than in a high yield fund because of idiosyncratic reasons. The other second largest, I would say, is going to be CLO. So you can see that towards the right, CLO is where the diamond is about 16% of the portfolio. Third would be asset-backed securities, just to the left of CLO here, which is about 15% of the portfolio. And then next up would be bank loans. So those are the 4 asset classes that we are currently invested in. Again, these are entirely idiosyncratic investments. And I would say there's a number of different sectors within high yield that I'm happy to speak to in terms of where we're finding opportunity. CLOs particularly are a very attractive asset class for us, both CLO debt tranches, and we have a few percentage points in CLO equity. Asset-backed securities, again, a few percentage points in ABS residuals, the equity tranche of ABS, but also ABS debt primarily. And that could be auto loan, consumer loan, equipment lease. There's many subsectors of ABS, many deals within those subsectors that we're finding attractive. And then finally, bank loans, which actually we came into the year about 3% bank loans, and currently we're about 10% bank loans. Part of that shift, again, not a view on the asset class per se, but looking at the percentage of loans that were trading above par in December. That was about 75% of the market trading above par in December. That number today is 2% of bank loans are trading above par. And so the positive convexity, the better, risk reward profile of many of these underlying holdings has prompted us to take advantage of some entities that we like in that space. One other thing I'll mention on bank loans, by the way, is there's a technical or structural dynamic here where CLOs that are capped at 7.5% triple C bank loan, that's structurally how CLOs work. those CLO managers have been kind of triaging their triple C and saying, you know what, if we're coming up against this 7.5%, we're going to divest some triple C or even B minus exposure, because if they surpass 7.5%, they have to mark those loans in their CLO. They do not want to mark those loans. So they're divesting that risk, not for fundamental reasons, but for structural reasons. And that's one of the great things about this portfolio is we want to be the liquidity provider for folks that are playing a different sport than us, whether it's a mutual fund that has to redeem because they're seeing tremendous outflows, whether it's a bank that needs to offload risk because of capital requirements, or whether it's a CLO that needs to offload risk because of structural requirements.
That's an interesting dynamic there. Now, within the performance over the last year, is it safe to say that you guys are keeping up with where you think you should be? Is there an opportunity here for some newcomers to be buying things that are discounted in the portfolio?
Yes to both. So this year we're down about 2.9%. Long-term returns are still extremely compelling. So we've returned over 50% since inception, with the high yield market returning about 30. So we've, since inception, the long-term 5-year numbers or even 3-year look very compelling. Of course, we were positive through this year, through the end of first quarter, and then obviously April, reciprocal tariffs, Liberation Day. All of that volatility we are not immune to. So we came into the year generally with high yield spreads at 292. They widened as much as 170 basis points this year to 461 at the peak. That was April 7th. And so we're not immune to that, especially considering when you look at sub-index level spreads, like single B spreads widened 190 basis points. Triple C spreads were out almost 400 basis points. And so, yes, we were not immune to that degree of spread widening. So we're down about 2.9%, most of that coming from April. But that's sort of what we'd expect to be down in that type of environment. And the good news is the interval fund structure puts us in a very unique position to add in this environment. So we have been adding. I'll talk to you a little bit about what types of credits we're buying. But I think the important differentiator here is if you think about outflow from high yield and bank loan mutual funds. 2 weeks ago, they had the largest weekly outflow since the global financial crisis. 9.6 billion went out of high yield. 6.5 billion went out of loans. And so this year, this month, 12.2 billion in total has gone out of high yield. So these are record numbers. The unique part about this portfolio, of course, is that while high yield funds, bank loan funds are selling because of redemptions, we are on the other side of that, putting cash and net inflow to work. So we came into the year with about 10% in cash. That's come down to about 3.8% because we put money to work. And so that puts us kind of in a unique position that we were in back in 2020, by the way, during the global pandemic. Same exact scenario. You saw tons of redemptions, tons of outflows, tons of what we would call forced selling in the marketplace. We were kind of sitting at the exit saying, we'll take that off your hands and it's going to cost you.
Sure. Awesome. Hey, how would an investor think about using credit ops for their yield portion? You guys distribute the income. Is it monthly? Would there be scenarios where you would dip into NAV to support yield?
Okay, so we do distribute income monthly, and we right now are looking at a yield of about, I'd say, close to 11%. And so the yield to maturity on the underlying is are around 11%. By the way, duration is around 2.2, so 11% yield, 2.2 duration. Average prices are in the 90 cents on the dollar range. And by the way, I always say I don't quote the average price to suggest that goes to par, because we are a portfolio that is persistently looking for dislocated, mispriced credits. And so it's not that we're riding that price up to maturity at par. We are tactically, taking proceeds and reallocating to, lower dollar prices. Yeah, monthly distributions, 11% yield, 2.2 duration, 90 cents on the dollar average price from a new buyer's perspective. Those are very attractive characteristics.
Absolutely. Would the NAV will fluctuate, moderately, somewhat, wildly? What best describes the NAV stability of the fund?
Yeah, I think we take credit risk in this portfolio, so you'll see NAV fluctuation. Obviously, the 2.9% return that we see, negative return we see is partly due to price degradation given spread widening. So it's not a stable asset value type of portfolio. It is a total return portfolio. But at the same time, I will say, we think about back to 2020. This has been pretty time tested, right? We had 2020 under our belt. This is global pandemic. In that period, we did draw down, pretty much comparable to the high yield market. But it's important to recognize that on the full calendar year, the fund was up 12.8%, while the high yield market was up 6%, and the average high yield mutual fund was up 4.9%. And I share those numbers just to say, yes, we'll draw down, but again, manager skill and the ability to put money to work in those environments, given the structure, tend to give us an advantage to do better on the other side of that type of volatility. The other thing to point out is we did see the worst bond market on record. That was in 2022, right? So that's again, global pandemic, worst bond market on record. It's been pretty time tested. In 2022, 9% inflation, massive Fed hike. We were down 8.5%. That number actually is what makes most folks most attracted to the portfolio, because if you think about double digits in 2020 and 21, double digits in 2023 and 2024, then you start to think, well, in the down year, you must have underperformed. If you're outperforming in double digits on these, on either side of that, on the down year, you must have underperformed. When you look at the high yield market, it was down 11. You look at the investment grade credit market, it was down 15. You look at the Bloomberg Ag, it was down 13. And so we actually did relatively, hold up pretty well in the 2022 market. So yes, NAV, will move. It's a credit portfolio, but historically we've been very happy with how we've performed in global pandemic, worst bond market on record, and of course the years where we were up double digits.
And for many of the reasons why you guys are in our recommended list and our guidebook for downside protection and participating on the upside, would you say that you guys then are macro aware but not so benchmark hugging at the end of the day when you're going to build a portfolio? It's what are you guys gauging to?
I think that's a well said. I think that we don't ignore it. When I say this is a very bottom-up idiosyncratic portfolio, we certainly do not ignore the macro. No manager should. So macro matters. If you're buying ABS, consumer, your outlook on the consumer certainly matters. Of course, there are structural protections in the ABS in general that help there, even if your outlook wanes a bit. But I will say we certainly consider macro, consider top down, but it's largely deal by deal item, line item by line item in terms of security selection.
Would we expect you guys then to have forecasts of interest rates and where rates might end up, or not so much?
Great question. Not so much. We do in other portfolios express views on interest rates by adjusting duration at the portfolio level using things like futures and whatnot. But in this portfolio, we deliberately do not do that. The duration of the portfolio is a byproduct of the underlying and solely the underlying. So we're not trying to express a view in interest rate directionality here. We want all of our alpha to be sourced from credit decisions. And to your point earlier about benchmark, we do bench versus the ICE B of A High Yield Constrained Index. That is a very good barometer for credit risk. It is a very well understood and well followed barometer for credit risk. But we're not a high yield fund. We're a multi-sector fund. We don't want to look like that index. There's about 1,800 high yield credits in that index. We have about 60 high yield credits, just to kind of put things in perspective, and overall about 120 credits. So or investment ideas, I should say. So we're not thinking about the benchmark in terms of overweight, underweight. It's a really important distinguishing factor of this portfolio, because you might see a benchmark relative manager say, hey, I have low conviction in XYZ name, but I'm going to own it anyway because it's a meaningful part of the benchmark. And I'll express my low conviction by underweighting that particular issue. Here, we express low conviction by not owning it. We're just void the credit. If we don't have high conviction, it's not considered a best idea across the platform where we really can understand and dimension the downside risk. We just don't own the name.
All right. Is there an ability to go short any views if you had a view to be short?
There certainly is. It's not a core part of the portfolio, but we have taken short positions via CDS. And so, if we feel that there is, the view, the market view is incorrect from a pricing standpoint, we will take a short position via CDS, a CDS long position.
So 120 total investment ideas, fairly concentrated then when we look at that versus the indices that have over thousands of positions. You guys have a domestic fund as well, right? So it's the same exact strategy, same team for the domestic offering.
That's correct? Right. Yeah. Essentially, the offshore is a feeder into the domestic.
Awesome. And then let's touch a little bit more then on the daily dealings and the monthly subscriptions. It's done as a mutual fund.
Yes, in fact, I would say the commonalities with a traditional mutual fund are more plentiful than the differences, in the sense that when you think about a traditional mutual fund, and by the way, that's why for folks who don't have alternative exposure, we've seen different subsets of investors in this portfolio, folks that have been using private equity and private credit and other types of alternatives for their, for long periods of time investing in this product because it's an opportunistic credit portfolio that complements that. But we've also seen folks that have never used alternatives and use this as a way to kind of dip their toe into the alternative space, especially considered many broker dealers are sort of trying to persuade folks to increase their allocation to alternatives because it's such an attractive space. This is a great way to kind of say, hey, if you're not ready to kind of dive headfirst into a 5 to 7 year lockup drawdown structure, this is a way to kind of step into the alternative space. Sorry, I went off on a tangent there. I forgot part of your question, but that's sort of where we've seen it used on both sides of that equation.
It's a beautiful gateway product to on these cylinders. The subscription then is I mean it's a mutual fund ticketing process. There's no subdocs on the offshore side. Same thing on the domestic side.
That's right. And different firms treat it differently, but for you guys, there's no subscription documentation. I would also mention, we've made a list of things like 5 ticker symbol, similar to a traditional mutual fund, similar tax treatment, monthly distributions. You can buy it any time. Really, the main differences are the redemption limit and the quarterly liquidation.
Okay. Quarterly liquidation up to a cap on the size of the fund, similar to these evergreen private credit funds that we've become very used to. Is that
5%? That's right, 5%. So if if in aggregate the redemptions exceed 5% of shares outstanding, we can then prorate. Everyone is treated equally, and we prorate. Hasn't happened yet. The day will come, but that's where we stand.
And look, at the end of the day, we're a fan of that because it protects the investors in the fund, and it's for everybody's benefit. So that's fair. That's what we've got.
That's exactly right. That's sort of what we attributed it not happening yet. I mean, again, like I said, we will prorate in the life of this portfolio. But when we think about the investors in this portfolio, they see that as that's actually why they're investing in this. They want that 5% because they don't want their assets, these particular assets, commingled with the world where essentially they're at the whim of other folks forced selling or irrational selling. And in our view, if you don't need the liquidity at the end of every day, this is the ideal vehicle, because if you're in a traditional mutual fund with daily liquidity and you don't need that liquidity daily, you're subsidizing that liquidity for the other investors, and basically passing on the complexity premium and the illiquidity premium that you can capture in a portfolio like this.
Yes, and for having daily liquid instruments in this structure, you're picking up this illiquidity premium, even though you're not investing in illiquid securities.
Yeah, and I would think about it a little bit differently than, on the private credit side, there's a passive illiquidity premium where, the lender is making the loan for the life of the loan. It's a buy and hold, hold to maturity type of structure where you passively collect an illiquidity premium, and they are illiquid. They are not traded, right? In this portfolio, these are tradable. The illiquidity premium comes just from the fact that some of them, not all, but some of them are less liquid. And therefore, if you own a single B tranche of an ABS security, for example, or if you own a dislocated corporate bond that is trading 100% on, idiosyncratic factors of that specific issuer, those things tend to have less liquidity than, your typical AA, single A corporate bond. Also, by the way, we can own, given our relationships, we can own, let's say, an entire BB tranche of an ABS deal. We can just own the whole piece of it. Is that tradable? Yes. Is it marketable? Yes. It's just less so.
Okay. Coming up on our 30 minutes of allocated time. Time flies when we're having fun. I'll leave you with some last thoughts on how we're thinking about Lord Abbett and Credit Ops Fund, and a huge thank you, because you guys have been tremendous partners to us across the board.
Yeah, you're very, very welcome, and thank you guys for the business. We appreciate the partnership, and I do these calls, on this portfolio all day long. So one thing I will just say is, I'm happy to set up a call with anyone at any time, just to kind of discuss, what we're seeing in the market overall, what we're doing in the portfolio specifically, where we're allocating, where the best, ideas are coming from, maybe some examples of things. We're happy to do that at any time.
Amazing. Ladies and gentlemen, Michael Cibelli with Lord Abbett, and we're discussing the Lord Abbett Credit Ops Fund. It is available for offshore as well as domestic clients. One of our favorite funds in the guidebook. And Michael, again, thank you so much for your time.
Thank you. This has been great. Take care.